Earlier this week, everyone watched Google I/O to see the new features. But if you're just looking at the shiny new product releases, you are completely missing the structural, multi-billion-dollar cost advantage that the competition literally cannot replicate. While other AI labs like OpenAI are paying massive margins to chip suppliers and server providers, Google has bypassed this entire margin trap. But it comes with a high price tag. And when you run the reverse discounted cash flow, the market is pricing in a growth rate that doesn't leave much room for error. Today, I'll break down Google's fundamentals to show you exactly why the market expectations are pricing the company for perfection, even though the business is booming. And if you're new here, my name is Florian and I'm a physics engineer from Germany that has worked in the semiconductor industry for over a decade. Welcome to the channel and thank you for joining me today. So earlier this week, Google held the annual developer conference, Google I/O, where they showed a lot of new features and products. This included their brand new family of Gemini 3.5 models, new AI workspace integrations with personal AI agents, updates on their TPU chips, and even what they called the biggest update on the search function in 25 years. And of course, the market spent the last days dissecting the keynote. But the press is obsessed with the what. And that's exactly the problem. Because if you are chasing the features, you are missing what's behind it. These releases aren't just product updates. They are the output of a vertically integrated development cycle that's becoming uncomfortably difficult for competitors to replicate. We are going to look at the fundamentals in a moment, but keep your eyes on the cadence. Because Google isn't just shipping software. They are running a compounding machine where silicon feeds AI models, which feeds cloud infrastructure, which feeds the next iteration of silicon. It's a flywheel. And it's moving faster than the cycles we are seeing from the rest of the industry. But how much faster are they exactly? Companies like Meta and OpenAI are running on a 12 to 18-month cycle. This is the time it takes them to get chips, train the models, and fix the bugs. But Google, on the other hand, even though they had a bit of a slow start, are moving on a 6 to 9 month timeline. The only other major model provider that can match this is Anthropic. And this isn't just about bigger R&D budget. It's a structural advantage. Most labs are effectively renting their processing power. Anthropic, for example, partners with all major cloud providers and also some smaller ones. But that means that they have to wait for someone else's supply chain. They are stuck waiting for someone else to build up the hardware before they can actually get to work. Google doesn't wait. They are building their own chips with the TPUs and the Gemini models at the same time. They are co-designing, and by doing this, they can perfectly match the chips to the models and vice versa. They also don't have to wait for any other hyperscaler to build up the data centers first. Of course, they still have to wait for TSMC to build the chips, but still. Now, I have talked about the elephant in the room, the high capex costs on this channel before. And while the current investments are pretty significant and do bring some operational risk, they are also the price of building a moat. Because if you are a competitor and you have to decouple your hardware from your software, it means that you are slower. And in the current market, where the models are still evolving and improving quickly, that speed is everything. So Google isn't just selling a chatbot. They are selling a development cycle that the competition literally can't match because they don't own the infrastructure or the data to do this. And to see why this is a real moat, look at how the rest of the AI market is built. It's completely fragmented. You've got Nvidia and TSMC making the chips. You've got labs like OpenAI training models on rented servers. And then you've got enterprise software companies building apps on top of these models. Everyone is paying a margin to the layer below them. It's basically a middleman trap. If chip prices go up, the model labs get squeezed. If the rental rates for GPUs drop, the neocloud provider gets crushed. Google is the only player that bypasses this trap. They aren't paying a markup to cloud providers because they have their own data centers, while still having the pricing power of the AI model providers. And they don't have to burn billions on custom acquisition because they already have billions of users on Search, Android, and their workspace products. As Dylan Patel from SemiAnalysis pointed out last year already, this is a huge architectural advantage. because the hardware infrastructure on which AI is run on has a direct impact on the margins. And not to mention that Google also rents these chips to other AI model providers like Anthropic. Now, I mentioned before that the CapEx spending brings some operational risks. And for this year, the expected spending for Google alone is close to $190 billion. But they are not building these data centers on hope alone. They are building them to support a cloud business that's already accelerating. In their last quarter, they reported a growth of 63% compared to the first quarter last year. And not only that, they also have a backlog of over $460 billion. This is nearly double the backlog they had the quarter before. But the story doesn't even end here. Because when we look at the pure tokens, Google processed 9.7 trillion tokens per month 2 years ago. This number jumped to 3.2 quadrillion tokens per month today. That's an annual growth rate of over 1,700%. Now, this growth rate is hard to grasp, so I couldn't help myself and ask Gemini to visualize this with day-to-day objects. The first comparison it came up with is a cup of coffee. If you start with a regular cup of coffee and increase the size of the cup each day to match this growth, the coffee you have to drink after 2 years fills up an entire 30-gallon fish tank. Or if you start with a stack of paper with the size of a human, after 2 years of growth, this stack is 1,980 feet tall, higher than the One World Trade Center in New York. And because they designed the silicon and write the code, this CapEx is also a cost-cutting play. If Google can drop the cost per query or per Gemini chatline, this can supercharge the margins, as I will show you in a minute. But before we dive into the financials, if you like this kind of objective and data-driven look and think that it helps your own investing, hit subscribe. I post 1 to 2 of these data-driven deep dives per week, focusing strictly on the fundamentals. Alright, so time to look at the numbers. Does Google actually print cash, or is this just an incredibly expensive science project? The Q1 2026 earnings pretty much settled that debate. Total revenue, here in blue, hit $109.9 billion, up 22% year over year. But the number that was really surprising was the EPS. It came in at $5.11, an increase of 82% compared to last year. Now, we have to be a bit careful here, because the large part of this came from special effects. The pure operating income grew by around 30% year over year. But if you want to see the growth machine in full action, you have to look at the Google Cloud. Because for years, Google Cloud was a low-margin, lagging third-party player behind AWS and Microsoft. But not anymore. Last quarter, it crossed a $20 billion quarterly revenue run rate for the first time with a year-over-year growth of 63.4%. To put that into perspective, Google Cloud grew at 30% and AWS grew at 28%. So Google is outgrowing both, although they still have the smallest market share. At the same time, a study from last summer shows that Google could cut the energy consumption per Gemini prompt by 33 times, partially thanks to their own TPUs. This proves that they are able to scale up while at the same time reduce the costs. And this is also visible in their margins. Google could increase their margins all across the board over the last 5 years. And at least for the time being, this trend is still picking up speed. When we zoom in on the last quarters, we see that there even was a pretty large jump in the most recent quarter. In this one quarter alone, they could increase their gross margin by around 3% and their operating and EBITDA margin by around 5% each. When we compare this to their direct hyperscaler peers and Meta, this is by far the quickest growth recently. The only margin metric that is under pressure is the free cash flow margin. This is due to the pressure on their free cash flow that comes from the immense CapEx spending. Now, this looks all pretty positive for the company so far. But let's stop cheering for a moment. Because as rational and objective investors, we also have to look at the risks. And the biggest risk is directly targeting Google's core cache engine, the Google search. When an AI overview triggers at the top of the search page, the first link loses 80% of its click traffic, as recent studies show. And the second link, even 39%. These AI overviews are currently being shown in 30% of all Google searches, up from around 5% last year. By the end of this year, this number is expected to reach around 20 to 25%. And losing these clicks puts direct pressure on their search ad growth and revenue. Then there is of course the sheer weight of the capital cycle. Spending $190 billion a year on infrastructure creates an unbelievable depreciation track and is pushing their free cash flow down. And if the current demand is in any form disrupted, those data centers could turn into underutilized assets that will eat through Alphabet's return on invested capital. We also have the constant ongoing antitrust cases against Google. Last year, the courts rejected a structural breakup of Chrome and Android. But the judges still banned exclusive default search contracts, which means that the multi-billion-dollar arrangement with Apple is on hold. And because of Google's dominant position, the last word has not been spoken here. Another thing is that despite the TPUs and quick update cycles, the market share of Gemini is still pretty low in the US. Here, ChatGPT is still by far the biggest player with almost 60% market share. Internationally, this looks a bit different. Here, Gemini has more than doubled the market share than in the US alone. And it could also snatch up market shares mostly from ChatGPT over the last year. But the US is currently still the biggest market for them, and here they seem to struggle a bit. Now, for us investors, it doesn't just matter what the company does, but also what you have to pay for this. So, what is the market currently pricing in? Right now, Alphabet is currently trading at $390 a share. That puts the forward PE at 31 times and EV to EBITDA at 19.3 times. That's a premium compared to its 5-year historical average of a PE of 33 times and EV to EBITDA of 14. But look at the peers. Microsoft is sitting at 22.8 times PE after the crash earlier this year, and Amazon is at 32 times. And remember, Google Cloud is outgrowing both of them right now. But multiples only tell you what the market mood is. To find out what the company is actually worth, we have to do a discounted cash flow analysis. And if we plug in a 7.8 WACC and a 3.5% terminal growth rate into a reverse discounted cash flow, the math shows us a clear hurdle. Because buying the stock today means that you are betting that Alphabet can grow its free cash flow by 31% every single year for the next 5 years. Analysts expect the revenue to grow by around 19% for the next 3 years and the net income by 16.60%. And the free cash flow growth should be even negative because of the huge capex costs. So the growth rates that the market demands for the current price are pretty high. For my calculation, I have toned it down to a more conservative but still aggressive 22% annual growth rate. And with these assumptions, the model spits out a fair value of $276. That implies a downside of 29% from where the stock is trading today. Even in my most bullish scenario, we end up at around the stock price today when we don't include any margin of safety. Now, for such a quickly growing company, every small change in the input assumption makes a huge difference in the output values. That's also why these kind of companies are very hard to model accurately. But this is where the sensitivity matrix becomes your best friend. Because here we can see how changes would affect the outcome. And in Google's case, the company would need to grow quicker in their terminal growth rate or their short-term growth rate than I assume, while at the same time also lowering the cost of capital. Now, if the $462 billion in cloud backlog that I showed you earlier triggers an exponential and high-margin software scale, this might not even sound too crazy. But there is not much room for error. Because of this, Alphabet also gets a pretty mediocre score in the valuation and momentum category of my stock rating system, even though their momentum is pretty strong right now. But their growth score is with 8.4 out of 10 very good, even though analysts expect that the growth will still be a bit lower in the next years than it has been recently. What really stands out is their almost perfect score in health and profitability that comes from their high margins and clean balance sheet. Overall, they get a pretty good score of 7.7 for 5 years and 7.6 for 10 years here. So, the question is not whether Google is a great business. The question is if you believe that Google can grow at the speed that the market is currently pricing in. If they can keep dropping the costs of their AI quicker than the competition can pay Nvidia's margins, that 190 billion capex will pay off quickly. But if their search engine declines or the cloud backlog stalls, that valuation might collapse quickly. For me, I find the current valuation a bit expensive if you want to start a new investment. But I will also not start selling my own shares in Google. But as always, that's just my opinion. What about you? Do you think that their flywheel is picking up speed? Or do you like any other hyperscaler better? Let me know down in the comments. And if you now would like to know which boring old dividend stock just increased their free cash flow by 154% and is about to redefine the future of data centers, watch this video next. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.